Hello, everybody. At this time, we are talking about financial forecast. A financial forecast is a financial model that attempts to predict and estimate the amount of revenue and expenses a business will incur in the future. This might sound somewhat similar to a budget, but there is one key difference between the two tools. A budget is designed to execute on management strategies and align the staff with the organization's goals. It is effectively a roadmap created by management. Financial forecasting is a tool that analysts use to determine whether the organization is performing in line with the budget by estimating future revenue and expenses. And then we move to importance of financial forecasting for businesses. Financial forecasting is essential for businesses to plan growth strategies, manage cash flow, and ensure long-term financial stability. There are the key reasons why financial forecasting is important. The first helps in decision making, provides insights into revenue projections and cost management for better strategic planning. And then second, ensures regulatory compliance. Proper financial planning aligns with tax and legal requirements. And then third, assists in securing funding. Accurate forecasts improve credibility when applying for business loans or attracting investors. And then fourth, aids in business expansion. Helps companies analyze profitability before entering new markets. And fifth, improves cash flows management. Predicting income and expenses helps businesses maintain liquidity. And then we move to types of financial forecasting. Organizations have many varied reasons to conduct financial forecasting. For that reason, there are several types of financial forecasts. The first, historical financial forecast. A historical forecast uses data from past financial statements, including balance sheet, cash flow statements, and income statements to project future growth. This is an early and easy approach and the most common set of documents finance teams use to engage the business. And then second, cash flow forecasting. Based on factors such as expenses and income, cash flow forecasting involves estimating cash flow in and out of the business across a defined fiscal period. Although cash flow financial forecasting is more accurate over the short term, it has several applications, including budgeting and identifying immediate funding needs. And then third, sales forecasting predicts the amounts of products or services a business will sell during a projected fiscal period using one of two sales forecasting methodologies: bottom-up forecasting or top-down forecasting. Sales forecasting is useful for budgeting, allocating and managing resources more efficiently, and streamlining planning production cycles. Additionally, this is one of the most important forecasts that finance uses to connect and collaborate inside the business. And then fourth, budget forecasting. Budgeting and forecasting are two separate processes that work together in financial planning. Budgeting combines projected revenues with anticipated expenses to create a balanced financial map for future periods. This process, which involves input from various departments, promotes effective resource allocation and cost control. Forecasting, on the other hand, provides ongoing financial projections based on current data and trends. By integrating budgeting with ongoing forecasting, businesses can identify variances early and adjust their financial strategies. And then, who performs financial forecasting? Anyone who runs a business should be familiar with the fundamentals of financial forecasting. However, for those who wish to delve deeper into this topic, having a background in finance and business administrations can help provide an educational foundation to develop critical financial skills. Untrained business owners can perform basic forecasting through their market knowledge and simple math. However, formal training empowers business owners and employees to more accurately predict cash flow and resource allocation. With expert knowledge from a budget analyst or an in-depth understanding of the principles behind financial forecasting, business owners can take proactive measures to get ahead of potential issues and remain competitive in their respective markets. And then we move to the basic elements of financial forecasting. The first element about income statement. Income statement shows business performance across periods. The income statement reflects vital signs like revenue, cost of goods sold or COGS, gross profit, and then expenses, pre-tax earnings, and net earnings. And then second, balance sheet. This is a report of the assets, liabilities, and equity over the preceding forecasting period. It is a point in time financial snapshot of the company. And then third, cash flow statement. This shows the cash movements in your business. The purpose of this statement is to show the net change, increase or decrease in cash balance over each period. And then financial forecasting process. The first step about purpose. It is vital to understand the purpose for which the elaborate process of analyzing, processing, making changes, and constant monitoring is being implemented. And then second, gathering data. Gathering historical sales and marketing data along with financial statements could allow the management to make more informed decisions based on past performance adjusts. And then third, time frame. Creating clarity in terms of the length of this process can give the management and the other employees in the company a clear idea of what they are working towards in terms of daily action supporting the plans. And then step 4 about methods, and then 5th, results, and finally 6th, analysis. I think it is enough. Thanks for watching.